Hi, I'm Max Keiser. This is the Keiser Report. Hey, you know, a lot of people are just running around crazily, rioting, and all kinds of nutty stuff. The question is this all prophecy? Is it all basically been, foreordained? Is that a word? Ordained, that's it. Foretold, ordained. Here on this show, we pretty much told you all this was going to happen years ago, right, Stacy?
Well, I want to look at a few different, themes going forward and theories that have been long present and that could explain this, what we're seeing in the world over the past 10, 20 years. And that is, you have the Thucydides Trap, and we see that with this growing tension between the United States and China, and the fact that we outsource all our jobs to China. And the Thucydides Trap is the tension that arises when a rising power is about to usurp a declining power. So we do see that around the world. But at the same time, just as like nobody, the power, whoever is the power, the alpha, the super imperial power, they don't want to give up their power. Who wants to give up power, right? The same with on a generational scale we're seeing. So you're seeing what is called the fourth turning. And this was written about back in 1991. They predicted actually in this theory that in the year 2020, that would be the year where it all collides together. And they didn't even warn of this other bigger fourth turning coming with the Thucydides Trap. But here we have the Generation Z and the end of the millennials displacing boomers. Boomers don't want to give up their power, and they certainly don't want to give up their third element, the exorbitant privilege. Remember, it's the boomers who have more than any other generation really lived off the exorbitant privilege of a total fiat world based on the US dollar. So I think these are the three ingredients coming together. This is our theory, like looking at these three theories together, and perhaps this could explain.
Right. Well, so things go in cycles, right? Things go in seasons. We're familiar with the seasons. And then there are the cycles. There's the Kindrikov cycle. It's a 60-year cycle in economics. There's the boom and bust cycle. There's the fourth turning, right? So this is a book about cycles in American history that are roughly 70 years in length, 80 years in length. And that this fourth turning would be the beginning of a chaotic, tumultuous period. And it was foretold that in 2020, this would kick in. So it was predicted. And, we on this show have been talking about why in 2020 was cycle be 10 to 12 years from 2008, because in 2008, there was the global financial crisis. And the solution was not to reform the banking system to stop the crisis from repeating again. The solution was, here's a bigger credit line to the worst banks in America to do the same thing, but much worse. And we predicted within 10 to 12 years, there would be a repeat of the 2008 crisis, but much bigger, on a much bigger scale. So it's exactly what's happening now. So whether it's the Keiser Report banking crisis cycle, the fourth turning, the business cycle, the seasons, cycles repeat. As Lenny Bruce once said, the famous comedian from the 1950s and 60s, the earth is round, man.
Right. So, okay, the fourth turning, according to William Strauss and Neil Howe, who wrote this book back in 1991, when they were looking at these 80-year cycles, that's 4 generations. That started actually in 2005. The third turning ended in 2005. So remember, from 2005 was the beginning of this financial this crisis, this nonstop crisis, because that's when all that subprime mortgage fraud was happening and the packaging of that into fraudulent debts that were sold around the world. That was the beginning of it. So it always ends up in a huge explosive peak, like in the 1940s. We know World War II. That was the end of a fourth turning. So they were predicting from about 2020 to 2025, there would be the explosive end of this. But so I'm looking at all of these ingredients and these Thucydides Trap and the fourth turning and the exorbitant privilege ending. And we saw that happen in 2020 when we saw this USO, when oil prices went negative. That's the end of the petrodollar system. So I want to look at what the mainstream media and how they're presenting the tumult that is happening. Joe Wiesenthal at Bloomberg said, "Still, I think about the tweet I saw this weekend, someone claiming unironically that the reason people were protesting is because the Fed bought 900,000 shares of the JNK ETF. These are the junk bond ETF. And he's poo-pooing and mocking the idea that the Fed intervening in the markets and who holds these junk bond ETFs, who is the Fed bailing out, that this exorbitant privilege is not understood by the masses, that there's a select group of people who can make bad mistakes. You bought this junk, it was about to go bust, you got bailed out. The people on the street, there's still people who have not received their unemployment benefits 2 or 3 months later into this crisis. So you have those bankers got immediately bailed out instant, like Fed money gets deposited in their bank account. A lot of people are still waiting for their bailout funds.
This is an example of gaslighting, right? So Joe Wiesenthal at Bloomberg, he's their official gaslighter in chief, right? So he takes an obvious connection that the people are protesting because of an enormous theft of billions and trillions of dollars. And the role of the Fed that plays in this transference of wealth and
injustice.
The injustice, right? And he's trying to claim that no, you're the insane one, right? This is what the gaslighter does. They try to claim that no, what you're seeing, don't believe your eyes, don't believe your ears. You're crazy, right? So that's his job. And okay, he makes money as a gaslighter. Okay, I get it. But people should understand that what he's saying is patently false. There is a connection.
I think it's he could just be a Marie Antoinette-like figure, and he's not like intentionally gaslighting. He's not taunting anybody. He genuinely is he lives in Manhattan. He's from Bloomberg, multi-billionaire enterprise. That he can only see what all his friends, Marie Antoinette's friends, were nice and kind, and they were well-meaning and had good manners, and they spoke well, and they read well, and they understood beauty. And why, let's just give these peasants brioche if they're so angry.
No, I hear what you're saying in terms of Joe, that maybe he's just genuinely misinformed on this topic. But if you look at what he does over there at Bloomberg, is that every single time something comes up to challenge the status quo, like Bitcoin, when I told Joe Wiesenthal to buy Bitcoin under $10, he started gaslighting immediately.
Okay, let's move back to this Thucydides Trap and the fourth turning, because this is the way bigger story here, and the exorbitant privilege that went in this generational shift here, because the Federal Reserve balance sheet could reach $9 trillion. This is according to the Financial Times. Again, just like Bloomberg. So this is the world they know and understand, and they have received privilege from it. So you see, again, from the beginning of the fourth turning, 2007, barely anything on the Fed's balance sheet. Then the crisis hit in 2008, and you see the injustice of bankers getting bailed out, the rest of the economy getting nothing. And now we're up here, we've just soared to 7 trillion, and they're expecting it to soar by another 2 trillion. So within this theme of a generational battle versus a geopolitical battle between a rising power and a falling power, and the exorbitant privilege of the US dollar, which has maintained the power structure as it is, that's disintegrating, in my opinion, and that's the biggest story, in my opinion.
Right. Well, okay. So they say, oh, it could go to 9 trillion. Now, when it was at 2 trillion, not too long ago, we said they're going to follow Japan's footsteps, and it's going to be 100% GDP on the Fed's balance sheet. So this idea that it could go to 9 trillion, we know almost without doubt that it's going to over 20 trillion. It's going to go to 23, 25 trillion and higher. We know that right now. That's not even for debate. And why? Because in 2008, the economy died, and the only thing left was to print money and to support the quintillionaire class. The only play left is to buy their stocks for them. That's it. That's all we got left.
So again, the fourth turning started in 2005, and this is the rise of a new generation, the millennials and now Z. And what happened from there? You could see it in that Onion headline mocking these looters. Protesters criticized for looting businesses without forming private equity firm first. So this 2005 to 2020 so far, these past 15 years, we've seen the absolute plunder as a business model. Everywhere you look, private equity, we started with that. We talked about that recently. Then you saw the share buybacks, plunder, 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 derivatives explosion, plunder, 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 plunder. And that's the, whether they knew it like logically, and they were thinking about this, or it was just an instinct for their generation, is they knew it was coming to an end, and it was like plunder as fast as possible, take all the privilege that we have as a boomer generation that had the largest voting bloc, like take that and plunder as fast as possible while we still have time.
Right. And as I said, this was triggered in large part by 9/11, right? So when 9/11 happened, we saw an enormous acceleration of the plundering because the quintillionaires, the top 1/10 of 1%, got really scared. And as they pulled money out and they went offshore with that $25, $30 trillion pool that's managed by the 4 big accounting firms, including KPMG and others, we saw a need for the M2 money supply to ratchet up rapidly because a lot of that was being stolen out of the system, siphoned out of the system. And then when they did this M2 money expansion and the balance sheet of the Federal Reserve expanded so rapidly, what they did was to appease their sponsors over there in the quintillionaire class. They bought their stocks for them and they put it on the balance sheet of the Fed.
And while the supply went up, what did the velocity of money do? Crash. Since 2000, we've shown this chart just recently in the last 2 weeks, and that was the hoarding effect, the plunder.
Right. How does Joe Wiesenthal explain the velocity of money crashing? Joe Wiesenthal, can you explain that?
He doesn't think it's a problem.
Well, because he's gaslighting. I mean, if he were just look at 2 + 2 = 4, you know, that would be like beyond his comprehension. Like, oh my God, you're trying to distort reality. All right, we're gonna take a break, and when we come back, much more coming your way. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Gabor Gurbacs. He's digital asset strategist and director at VanEck, MVIS, an investment management company well known for its ETFs. Full disclosure, I happen to own some of these VanEck ETFs, including GDX and RSK. Gabor, welcome.
Well, thanks for having me. Good to hang out with the Keisers.
Mi casa e su casa. So VanEck is most known for these ETFs, exchange-traded funds. Briefly explain what an ETF is to the audience and how they first came about.
ETF means exchange-traded fund. So basically a fund that is traded on an exchange like a stock. Traditionally, mutual funds have only traded at the end of the day, but by the introduction of ETFs in the early 2000s, you can start trading funds or pooled vehicles with multiple securities underlying, like stocks intraday. So you could express your opinion on the market, the sector, a country, or a commodity, pretty much intraday in real time. And this made it very convenient for investors to trade at regulated brokerages with real-time data and low costs.
Now, VanEck created America's first gold fund back in 1968 when the company rightly predicted inflationary pressures coming as the U.S. spiraled toward abandoning the gold standard. What is the case today for owning gold in a world of Bitcoin?
VanEck indeed was one of the companies that correctly identified the coming inflation, and we actually, in fact, identified trends that likely create impactful investment opportunities, and that was the gold one in 1968 by John VanEck. And we're also one of the very early firms who provided access to international markets. And so the base case that, or the investment case that I think is important for gold is it's the largest safe haven asset today. $8 trillion, very liquid markets. Central banks own gold, and there are tons of vehicles in the market, like exchange-traded funds, mutual funds that offer exposure to gold and gold equities. So today, the institutional investors that we see are still picking gold over Bitcoin, as it's a liquid in large markets, it's established, and it's regulated in a way that's and liquid in a way that investors prefer. Although I think Bitcoin has a chance to become digital gold, and it's on path to just do that.
Large institutional or large brokerages and money managers like VanEck and others. You know, I remember back when I was working on Wall Street in the 1980s, you know, we were dealing with VanEck all the time, and it's got a great reputation. But, you know, these types of organizations are not necessarily known to be on the leading edge of finance innovation. And yet VanEck just jumped right in the Bitcoin pool right away. Kudos for that. And I think it served you guys very, very well. You have recently been quoted, Bitcoin is a non-violent revolution against central bank monetary control. Tell us more.
Yeah, I do think that central banking activity has picked up, particularly after the 2008 financial crisis, and if there's trillions of dollars printed out of thin air, and the average investor doesn't have any control over this process or say in it. And my belief is that the average person should have some say. So the only way to express an opinion is through investing, and that's why I think Bitcoin and gold are similarly non-sovereign issued and non-sovereign created currencies, and it is a revolution. Bitcoin, that is, that investors can and people can generally use to express their opinions. Again, I think central banking has gone too far in depreciating currencies and making decisions on behalf of people, and there's no way to opt out except through these currencies that are not directly regulated by central banks. And I think there are millions of people that have an interest in non-sovereign issued currencies, and it's not necessarily because they don't appreciate governments and forms of governance. It's just because the value of dollars and fiat currencies are depreciating in our pockets. So to hedge against this kind of depreciation, people are looking to invest in the markets, and I think Bitcoin is one of those instruments that has emerged as sort of a potential store of value, and gold obviously is functioning as a non-sovereign issued store of value. And frankly, I think in fact, like if you look at the history of central banks are buying gold around the world to hedge against themselves. So Bitcoin being another alternative is actually very positive for everyone, including central banks.
Explain to me how it works over there at VanEck, because you've got, of course, maybe some different camps, different ways of thinking, because since the recent crash in the stock market and the huge bounce back in stock, what we know is that it's almost entirely driven by central bank money printing. The fundamentals are horrible, and yet stocks are going higher thanks to the Fed buying stocks. The Fed is actually buying ETFs, right? Without the Fed, there would be no stock market rally at all. They're the only, as a matter of fact, they outbid Warren Buffett for airline stocks. That's why he didn't buy any airline stocks, because the Fed outbid him to buy airline stocks. So within the VanEck community, is there two separate camps? Because you're talking about a nonviolent revolution against central bank monetary control. Meanwhile, there's other funds in the VanEck umbrella of funds that are participating directly in the central bank monetary control. What's going on over there? Anything?
So, I mean, obviously there are, the firm has many different expertises, different managers, and my general theory is that people should invest in the stock markets and should participate in the economic reality, and they should have some reasonable exposure to stocks, bonds, and whatever is available out there. I'd also emphasize, and this is what the financial service community happens to forget, that it's good to hedge for scenarios when things can go wrong, and that's why it is my responsibility to add the view of gold is important, Bitcoin is important. Watch out for inflation. While we're in a deflationary environment today, the real cost of living in the top 50 U.S. cities is increasing 10% in a year. So these are, in every company there are managers, for instance, like myself, that try to call attention to catastrophic scenarios like central bank failures, extreme inflation, and the valuation of investments. Things happen fast in this market, so I'm in the camp that that warns others to sort of complement their portfolio with gold and Bitcoin to prepare for a potentially catastrophic scenario. And beyond that, we offer exposure to different country stocks: Russia, Vietnam, Indonesia, interesting areas like esports, core investments, bonds, and everything like that. But we also try to highlight the risks in the system, which we, I think, do more prominently than many other asset managers enhance our efforts in gold and the Bitcoin market, and hoping that one day people will be able to express their opinion through a Bitcoin ETF as well.
Fair enough. Now let's get into some nitty-gritty here, because there is no Bitcoin ETF, which is really surprising to me, because there's obviously a huge market for this. Barry Silbert over there at Grayscale, he's pulling in hundreds and millions of dollars a quarter, right? He's eating the fund industry's lunch. He's making the ETF industry look very slow and unresponsive to the public demand, the public market. Why is there no Bitcoin ETF?
And there should be a Bitcoin ETF. I mentioned this many times, and obviously working on this for years. So my belief is that Bitcoin brings a ton of structural benefits to the markets, and so one of that is daily proof of reserves, transparent holdings, prices, proper tax documents, and intraday tradability with no lockups and high premiums. Those are all benefits that would help the average investor to access this market in a liquid and regulated way. And that is literally the mission of regulators. So I say that, and they should actually approve a Bitcoin ETF to allow people this kind of more liquid and transparent instrument. Regulators are dragging their feet as this is a new asset, and while we know that Bitcoin is more than 10 years old now and established, in the grand scheme of things, it's actually a very limited amount of time. When VanEck brought to market the first gold equity ETF in the 60s, it took time. It took time for us also to build established country funds that were not favorable at the time. It took time to build an esports fund. So it just takes time for regulators to understand this market. Though I do not believe that they are correct in their assessment that there's more risk in manipulation in Bitcoin than other markets. I've written numerous studies and papers showing that Bitcoin is just as good as a market as gold and other commodities are. So eventually, I think regulators will come around, because Bitcoin is already ubiquitously available on crypto exchanges and in random closed-end funds and private vehicles. And the logical next step would be to really allow Bitcoin to come to the ETF space. And in fact, the ETF market has become a $6 trillion industry in roughly 20 years. I do think that the next phase of ETFs and the next great investment vehicle will have something to do with Bitcoin and tokenization. So as ETFs were very small 20 years ago, and now it's $6 trillion. It might go to $20 trillion in the next 10 years. But, what's the next ETF? And that investment structure is going to be brought about by Bitcoin and tokenization. And so this is very good that we are looking into this for the regulators right now. And eventually, my hope is that they will come around. It's not, the shortness of effort, to bring about a Bitcoin ETF. We've been trying and put proper controls around the vehicle. It's just regulators haven't made up their mind yet, and they usually take their time.
Right. Let me pose a scenario. You tell me if I'm being paranoid or not. Because the regulators say that one of the problems with the Bitcoin ETF is they don't have good price discovery on these exchanges. And at the same time, they're perfectly happy allowing an ETF in the oil sector, like it goes under the ticker symbol USO. And my question is, are the regulators seemingly playing favorites here? Because obviously a Bitcoin ETF, if it's a threat to the industry that they regulate, is that an issue in this case? Because this argument about accurate price discovery doesn't hold water. It's obviously a red herring, because you can easily disprove that. But am I being paranoid? What do you think?
I think you're absolutely correct. There's a persistent double standard against Bitcoin and digital assets, which I think is wrong. I've shown it again in numerous studies, public and private ones, to regulators, that Bitcoin price discovery is efficient and, in fact, more efficient than some of the commodities, as you mentioned, some of the oil markets. And I think one of the solutions that we've worked on is we have a German subsidiary called MVIS, a fully regulated index subsidiary that actually became the largest crypto index provider. So we actually built regulated indices that regulators started feeling better about, that helps price discovery. So we work with exchanges to get the right data. We show to regulators that it's clean data. We show that we do the same professional management precautions that we do with equities and other asset classes as well. And I think they're getting they're understanding this space a little bit better. I do not believe that pricing and price discovery is a big issue, and in fact, we have solved it. A number of our clients on this subsidiary have approved registered funds in Switzerland, Canada, and Japan, and like other places. So this is, I think it's important to know that global regulators have recognized that we have solved this problem, and sooner or later, the U.S. regulators will recognize this as well.
All right, Gabor, thanks for being on the Keiser Report.
Thank you for having me. Bye.
And that's going to do it for this edition for the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank our guest, Gabor Gurbacs of VanEck. If you'd like to reach us on Twitter, it's Keiser Report. Until next time, bye, y'all.